Why the US dollar index, DXY, has recently plunged, breaking below 2022 lows, exploring macroeconomic, geopolitical, technical, and market sentiment drivers. 1. Cooling inflation and Fed pivot disinflation signals. US PPI and CPI data have come in below expectations. For example, May PPI rose just 0.1% versus 0.2% forecast, heightening expectations for Federal Reserve rate cuts as early as September or late in 2025. Lower inflation typically leads to lower yields, weakening the dollar. Yield divergence. A notable disconnect has developed between Treasury yields and the DXY. Yields remain relatively firm, but the dollar has charted a steep decline, which signals a crisis of confidence in the U.S. economic trajectory. 2. Political and policy uncertainty, tariffs and tax policies. The Biden/Trump-era tariff rhetoric, threats of sudden new tariffs even on key allies, plus massive fiscal spending, a $3.3 trillion tax cut spending bill, have stoked fears of fiscal imbalances and recession. Central bank independence concerns, ongoing political pressure on the Fed, including potential revenge tax legislation, raises alarm about undermining U.S. monetary policy credibility. 3. Geopolitics and safe haven erosion. Muted safe haven bid. Unlike past geopolitical shocks, such as conflicts in the Middle East, the dollar has barely responded, only a -0.25% uptick, suggesting its refuge status is diminishing. De-dollarization trends. Growing interest in alternatives to the dollar, driven by geopolitical tensions and initiatives from large economies and central banks, adds structural pressure on the greenback. 4. Market positioning and sentiment. A sea of bearish bets. Institutional surveys, including BofA, show record pessimism toward the dollar, the highest in 2 decades, with sentiment turning bullish on emerging markets, gold and global equities. Hedging behaviors. European pension funds and corporate treasuries, once hedged, are now diversifying away from dollars, further undermining the currency. 5. Technical and chart drivers. Break of critical levels. Technically, the DXY has broken below the key 100 threshold and approached support zones at approximately 95 and approximately 90, levels unseen since 2022 or earlier. Bearish formations. A clear bearish flag has formed on the charts, suggesting continuation of the downward trend unless it rebounds above approximately 101-107 resistance. 6. Attractive alternatives emerging markets. Resurgence. As the dollar weakens and DM yields return, EM local currency bonds have attracted record inflows, with returns over 10% YTD in countries like Brazil, Mexico, India, and Indonesia. Gold, equities, and currencies. Fund managers have pivoted to gold, the top crowded trade, European equities and EM assets, while dollar positions are being offloaded. Outlook and key risks near term. Dollar may rebound modestly if Fed signals policy pause or hawkish tone, yield curve steepens, supportive for USD, market regains risk aversion, downside potential, DXY sliding toward 95 or even 90, marking deeper structural devaluation if fundamentals worsen. Watch points, US inflation data, CPI PPI, Fed communications and rate projections, fiscal developments, tax tariffs, geopolitical flare-ups versus past patterns. Final take. The dollar's fall is not a simple cyclical dip, but a product of interlocking pressures: cooler inflation, geopolitical and policy uncertainty, shaken Fed credibility, technical breakdowns, and global portfolio shifts. Unless U.S. fundamentals or policy credibility improve, especially if fiscal discipline returns and the Fed signals sustained monetary resilience, the path of least resistance remains downward.